Is a 50-year mortgage a blessing that home buyers have been praying for, or is it the biggest scam in U.S. history meant to curse them? So that is the biggest question that has been going around ever since President Trump has proposed this 50-year mortgage, and it has people in an absolute uproar, either for or against, and the arguments online are real. But there are a bunch of people who are hearing about this and they don't really know what to feel either way. They don't really understand what's going on and why people are so fired up for or against it. So let's talk about it. My name is Allison T. Paulino, elevating your real estate experience. I'm going to first off start with the disclaimer that I'm not mortgage loan licensed. And so this video is for educational and informational purposes only. Please consult with your loan officer or your financial advisor if there's anything in here that you'd really like to go over before making your final decision in your homemaking process. So now that we've got that out of the way, I'd like to go over a little bit about mortgages, and then I'd like to give you a little bit about the housing market history and what this 50-year proposal means to me, what my thoughts are. So first, let's kind of start with the mortgages. There's some people who really don't understand that there are hundreds of different loan products that are out there in order for you to go out and purchase a home. So the most common really is a 30-year fixed rate mortgage. Why? Because it's fixed. People know what they're going to be paying. They're paying it for a long period of time, and the payments tend to be lower than that of a 15-year. So when you look at these two different products here, that's really the main one that people argue back and forth on the market. Now, there are variable ones. You have them where there's a short term that is fixed, and then it has a variable interest rate that goes with the market. They tend to be year over year. Now, those could be 5, 7, 10, 15, 20-year ARMs. And the reason why people will get them is because for that fixed amount of time, people typically get a lower interest rate than they would. But if you were somebody who bought, let's say, before the pandemic and you got one rate and then all of a sudden the rate changed right at the pandemic, you were really taking advantage of those 4%, 3%, or in some cases even 2% mortgage rates. But as soon as you look at the beginning of this year, you were probably hit with that 7% rate. And honestly, one of the biggest things that people also don't know about history is still with these 7 and 6% rates, this is still a historical low. Honestly, there were some of us who were calling it a pandemic special when we were looking at those 3% and 4% interest rates. And those still are semi-possible, but you got to pay a big amount of cash up front to help buy that interest rate down. Now, one of the big things that we could talk about too is the affordability crisis. There were people who were really going out and saying across the nation, affordability for home ownership has really dropped. There's a gap between what we're being paid and what these prices are in order to get these homes. And you really can't blame people for talking about the fact that there really has been such a rise in inflation. Now, if you go on my Instagram, you can see that I did talk about what the market data looked like here in the Peninsula when it came to prices before the pandemic and now. If we're looking 2019 to here, just in the first 2 to 3 years, there was a 30+% increase in home prices. Now, here we are seeing much larger pay in the Peninsula Bay Area than we are, say, in, New Haven, Connecticut. But there is a very big difference in how much the pay rate went up versus how much the home prices went up. Now, there are some people who are a little bit misinformed on what exactly happened in order to get these prices to drive up as much as they did. And I do understand where some of that misinformation can come from. Some of it is the fact that there are people who are fully convinced that it was because of businesses buying across the nation cash. I want us to also remember that there are some homeowners who have been able to be blessed enough where they had families where they could stay and really invest in order to gain cash. And those large amounts of cash did help them as personal buyers give these large offers as well. There were also people who were able, with the pandemic, giving such a low interest rate, were able to pay for what's called an appraisal gap. It means that the house is not going to appraise for the price you're purchasing it for, but because those numbers did have such a large increase when you went from like an 8% interest rate to something around 4 or 5, people were able to pay the gap between that with a lower payment. So the 30-year, the most popular, we'll just go with that for the example in this here. If we look at it, the conventional loan really did only allow for a 20% down payment, and that became more difficult, especially as people were moving out of the house and starting their own lives a lot younger, as well as when they were single. And being able to save a large down payment at 20%, along with having to pay your rent and all of your monthly bills, just wasn't as feasible as it was in the past. So there was FHA. FHA was like, well, let's come in for those who have a lower credit score or any of those things. By the way, November 16th, those are going away for Fannie Mae and Freddie Mac. Disclaimer, let's get back to our regular scheduled program. But they did this and they said, let's give a 3.5% down payment. As conventional loans were watching these 3.5% mortgage loans go out and not be as high risk as they originally thought, they were like, you know what, let's put the PMI, which is private mortgage insurance, on these things, which actually is made to help them for the risk of foreclosure. And they said, let's go with 10%, 5%, and in some cases, people can even go as low as 3% with doing a conventional loan. Now, with that was able to help some people with their affordability issues when it came to the fact that they could afford the monthly payment, but they just didn't have the cash up front to pay in order to get into the housing market. Now, there were some of those people who did have a 20% down payment or 15 or even 25%, and they were like, you know what, let me go. I qualify for a 5% down. Let me go purchase a home. And because I wanted, it was a seller's market. There was about 100 buyers for every house that was on the market. And they said, let's outbid people because they really wanted these homes. And they were able to pay the difference between there. So say if a house was on the market for $1.5 million and they were like, okay, I can offer 1.6 because if the house appraises for only 1.55 and that $50,000, I have the cash for that appraisal gap. People were doing that in order to help themselves win in these bidding wars. Unforeseen, unprecedented, not really something that we were used to. But at the end of the day, people did what they could in order to win. So it wasn't just the large corporations, which were a small percent overall nationally in home purchase prices, but it did bring a lot of the people who were able to find creative ways to win these bidding wars. Now, as these prices continue to jack up, the correction on the market was giving a higher interest rate. Again, still lower than pre-pandemic prices, but people were doing this in order to say, hey, let's stop these prices from going up another 30 or 40%. So when that happened, it did kind of kick some of the buyers who were on the market and weren't able to win bidding wars or weren't able to find the houses that they want. It kind of hurt them in what their purchasing power was, which really, once again, brought up the whole cry for help with these affordability issues. Now, I don't think that President Trump bringing up this issue with the 50-year mortgage after his Japan visit was coincidental. And the reason why is because 50-year mortgages are actually not a new thing. So the UK does 50-year mortgages and they're not as popular. There's not as many people that do them. But Japan, they actually are pretty popular. They have 50-year as well as 100-year mortgages. Now, that's a really long time, 100 years. And what they do is they have it go from generation to generation. For them, it was a way to build generational wealth or be able to keep things within the family. And with that being said, we can go right into the pros and cons of doing a 50-year mortgage. Now, let me just start with pros, because let's go with the good stuff first. Again, as I talked about earlier in this video, a 15-year to a 30-year mortgage allows you more purchasing power. So there are people that would be able to buy a home that is either in the condition that they prefer, in a neighborhood that they wouldn't be able to otherwise afford. They can get a lower interest rate and a lower monthly mortgage payment in order to go on the market. Now, that might be some people who were right on the cusp and found that the price point that they were approved for just doesn't allow them to buy on the market in the area that they're looking in. And for some people here in the Peninsula, that could be about, somebody saying, I'm trying to buy here in San Mateo for $900,000. And it's just not something that they can actually afford to purchase. Now, with a 50-year mortgage, we could see that price point go way up, and they can actually get something that looks more readily available for what they're looking to get. And then it can also allow some people who were kind of on the fence about what to do, or people who are saying, you know what, I'm realizing I'm going to be renting for the next 50 years. Let me pay a mortgage and leave it as an inheritance instead. So let's go into the cons, and that is the 50-year timeline. That is an extremely long time, and that is more than half of what the average lifespan is here in the United States. That's kind of scary to think about, right? And then there's also the fact that you're not going to be building as much equity as quickly. So if we look at how mortgages are structured in the beginning of the fee schedule, when you're making your monthly mortgage payments, most of that is going towards the interest, and then there's a smaller portion going towards the principal. With time, that number tends to flip, where a smaller amount is going towards your interest payment and a larger amount is going towards your principal. So this is how you build equity upon the house. And if you are somebody who is looking to build equity, it is going to be a much slower growth with a 50-year mortgage than it would be with a 30 or 15-year. Again, we're sticking with the fix just to make this as simple and clean as possible. With that being said, if you're somebody who's only going to be in a home for about 5, 7, 10 years, which is actually pretty popular. There are some people who are in the military, or those who do a lot of traveling for their work, and they have temporary stays. A 50-year mortgage could be something that they find attractive because of the fact that they're like, I'm going to be paying a lot less, and they're not as worried about the equity. They just kind of need to break even and move on. Now, if you're somebody who's saying in 5, 7, 10 years, I'm looking to get like a starter home, because most first-time home buyers do get a home just to enter into the market, take advantage of the equity, take advantage of the fact that their pay, as it's predicted, is to go up as they're in the workforce, sell that home and then purchase a new one with their higher pay as well as the equity in that. Your equity growth is going to be so slow, it's probably not going to make as big as an investment change as it would with a 30-year mortgage. Also, there's the thought of once again seeing something like the pandemic, where people are able to afford something a little bit more, or they did have a little bit more of a down payment in order to pay an appraisal gap, and they find, oh, wait, look, I can actually go in this neighborhood over here, and they start a bidding war again, which could cause prices to go up once again. Now, for me, and then there's also people who refinance, which is extremely common because the secondary mortgage market has lower interest rates, and that helps people lower their payments. So, for example, my dad, we had a conversation about what the fees look like for him to close, and we said it would only make sense for you to refinance if it was at least $500 or more a month, because then you're going to make up for the fees that you've paid within less than a year. He did it, and it worked great for him. Now, it's also because he was able to have enough equity that was already paid off in the home in a shorter period of time with his 30-year mortgage rate. So my thoughts on all of this here and why I think it works as a temporary solution. Very temporary. I think that it works as a temporary solution to help with that gap. And I think there would have to be a lot of tight regulations. So there are some programs like CalHFA or CHAFA, which Connecticut and California and in Massachusetts, where they have these down payment assistance programs that can give you up to 100% financing on a home for those who might have the other qualifications but don't have the money in order to pay for closing costs and all of those things. Now, these programs were put into place and they have a bucket. They have extremely strict rules and regulations, and they have a bucket of once we hit this amount and loans going out, then we're going to hold off on doing any more. So I think that with some tight regulations, making it where it's a person really couldn't afford in the entry point in certain areas, or if it was, hey, we're only going to loan this certain amount, or, oh, we're not going to be able to do it without, kind of similar to the down payment assistance program guidelines. Those are the only people. And I think maybe for about 3 to 5 years, just not where it's going to start pricing people out, to be something where if they're really willing to take the risk, because at the end of the day, the person doing the 50-year mortgage is the one who's going to be paying it, right? If they're willing to take on that risk, and if the American government is willing to only say, hey, this will be something we only allow for this certain time period, I believe it could be something that works. But again, only as something temporary, not to be brought up again. And so the reason why I think temporary is it just really allows those who have been discouraged or who have been really priced out or really pushed out of being able to purchase. It kind of gets them back into the market and get them an upper hand. Now, as a permanent solution, I think it is an absolute nightmare. And I believe it leaves too much room and risk for a 100-year mortgage to come into play, which I cannot fathom somebody telling me that this is for 100 years. I cannot fathom glorifying debt for multiple generations inside of that. Or if it was something where, again, with that temporary, because there are places such as Germany where if you purchase a home, you have to have a life insurance policy to go with it in order to make sure that you are not leaving your family in a gross amount of debt. I think that's a great rule just in general, but I think it's something that could be as some of those tight regulations to say, okay, a 50-year mortgage, but you would have to have a policy for at least 50 to 100% of this policy to make sure that if you were to pass away, someone else is not left with this very long-term mortgage afterwards. So those are my thoughts. Again, I think it only works as a temporary solution. If they want it as something permanent, I say absolutely not. And I would love to hear the consumer's feedback, because at the end of the day, it's what the people want. And what I want, what I think, might not be something that you necessarily agree with, but I would love to hear the conversations about how the American dream has changed, about how you feel that this 50-year mortgage could really make or break the industry from this point going forward.